Income tax 2020. Personal use of dwelling unit, including vacation home. Come in, relax with income tax 2020. Personal use of dwelling unit, including vacation home. When thinking about rental property with regards to our income tax formula, we are in essence up top on the income side of things. However, note that we do have a separate schedule, that typically being the Schedule E, which is in essence an income statement having income and expenses or deductions. Getting to the bottom line, that's basically the net income of the Schedule E or rental property. That bottom line then flowing from the bottom of Schedule E to the top of our tax equation, where we would then apply out our above the line and below the line deductions to get down to the taxable income. With the first page of the 1040, the Schedule E basically rolling into line 8 here. So we got the Schedule E net income in essence rolling into the first page of the 1040. We'll get into more detail on the tax forms and the use of the data input and whatnot with the software examples, but just to get an idea in your mind to visualize the forms, here we got the 1040. Schedule E looks something like this. We got the supplemental income and loss, first half of the Schedule E, second half of the Schedule E. You can see in essence we have here an income statement, bottom line then being the net income that pulls over to the first page of the 1040. Now remember that although at least the demo version or draft version of the Schedule E is out for 2020, some of the supporting information, including the publication 527 and instructions for Schedule E, are not out yet for 2020. Therefore, we're basing some of this information on the 2019 information, updating where we believe applicable, but just realize that the base of this information is coming from 2019 and then adjusted for. You can find this information on the IRS website at irs.gov, irs.gov, looking up publication 527, instructions for Schedule E as well. The 2020 updates should be out shortly. Personal use of dwelling unit, including vacation home. If you have any personal use of a dwelling unit, including a vacation home, that you rent, you must divide your expenses between rental use and personal use. So notice when we're thinking about the rental property, we talked about some common kind of scenarios that happen with the rental property that we don't see as much with other type of businesses, such as Schedule C type of businesses. And that's going to be this allocation. If we're using the property partially for personal and business use, we may have part of the dwelling that's broken out for personal and business use, part of the dwelling then being used for business versus personal, or we might have the one dwelling that's used for part of the year for personal or for business. So those are the two common type of breakouts that we got to be thinking about between business and personal. We have similar kind of problems, which is that when we think about the expense side of things, how do we deal with the expense side of things? How do we allocate the expenses? Obviously, on the income side of things, everything that we got that was income is, of course, rental income and applied to the rental proportion, because that's the rental income side of the income statement came from the rental property portion of whatever we did. And then we got to think about the expense side of the allocation, how we allocate those expenses out if there's something other than business use for that property. So in general, your rental expenses will be no more than your total expenses multiplied by a fraction, the denominator of which is the total number of days the dwelling unit is used, and the number of which is the total number of days actually rented at fair rental price. So let's take a look at that one more time. The numerator is going to be the total number of days actually rented. So we got to break this thing down to actual number of days. We got the total number of days rented, whereas the denominator is going to be the total number of days the dwelling unit is used. So the number of days used and the number of days rented is what we have here. Notice what they didn't say here is the number of days in the year. They didn't just say, 365 or the number of days within the year being the denominator. They said the denominator is when the dwelling unit was used. So that means that when we look at this ratio, it kind of makes sense. If you look at it, you're saying, okay, we break the days in the year out into the number of days that were used for the rental property versus the number of days that the dwelling was used basically in total. But then you can get into kind of a muddy area in terms of, well, can't I just divide it by 365? Or what does it mean for the dwelling to be used, and so on and so forth. And obviously this ratio can have a fairly significant impact on the deductibility of expenses if you make some adjustments to the numerator and denominator of it. So only your rental expenses may be deducted on Schedule E. So obviously only the part that's going to be related to the rental expenses are deductible. Some of the personal expenses may be deductible on Schedule A. So we have the same kind of situation we saw when we're using part of the dwelling for business versus personal. You might have some of the expenses that still could be deductible on Schedule A, such as the interest for the mortgage interest and possibly the property taxes if you are itemizing. And then you'd need to be breaking out between Schedule E and A. If they're not deductible elsewhere, the personal items, then you'd only get the deductible portion, which would be related to the Schedule E. So you must also determine if the dwelling unit is considered a home. The number of rental expenses that you can deduct may be limited if the dwelling unit is considered a home. Whether a dwelling unit is considered a home depends on how many days during the year are considered to be days of personal use. There's a special rule if you use the dwelling unit as a home and you rented it for less than 50 days during the year. So if it's basically your home, is the dwelling unit you're talking about now isn't basically a rental property other than the home. Now it's being assigned as basically the home. And then if you had less than 15 days of rental, you could have special rules related to that in that case. It's basically your home and you didn't rent part of it out, but rather you rented the whole thing out, but you rented it for a very limited number of days within the year. Okay, so dwelling unit. So what is a dwelling unit? A dwelling unit includes a house, apartment, condominium, mobile home, boat, vacation home, or similar property. So most things that you would dwell in, living in. So it also includes all structures or other property belonging to the dwelling unit. A dwelling unit has basic living accommodations such as sleeping space, a toilet, cooking facilities. So these are the things that you would typically expect to be in a dwelling unit to call it basically a dwelling unit. You got the sleeping space, you got the toilet, you got the cooking facilities. So a dwelling unit doesn't include property or part of the property used solely as a hotel, motel, inn, or similar establishment. Property is used solely as a hotel, motel, inn, or similar establishment if it is regularly available or occupied by paying customers and isn't used by an owner as a home during the year. So an example, you rent a home in your home. You rent a room in your home that is always available for short-term occupancy by paying customers. You don't use the room yourself, and you allow only paying customers to use the room. This room used solely as a hotel, motel, inn, or similar establishment, and isn't a dwelling unit because you're basically renting it basically as a kind of hotel or motel type of activity, and you're not using it personally, and therefore it's not a dwelling unit. So dividing expenses. If you use a dwelling unit for both rental and personal purposes, divide your expenses between the rental use and the personal use based on the number of days used for each purpose. So we got to think about the number of days used for each purpose. And again, notice we're kind of looking at each purpose of when the dwelling unit was used. They're not saying divided by the number of days in a year particularly here. They're concentrating on the number of days that the unit was used. So when dividing your expenses, allow these rules. Any day that the unit is rented at a fair rental price is a day the rental use, even if you use the unit for personal purposes that day. So once again, any day that the unit is rented at a fair rental price. So this rule doesn't apply when determining whether you use the unit as a home. So, and then any day that the unit is available for rent but not actually rented isn't a day of rental use. So if it was available for rent but not actually rented, then it's not going to be included, they're saying, in a day for the rental use. Fair rental price. A fair rental price for your property is generally the amount of rent that a person who isn't related to you would be willing to pay. So this is another common issue that you basically have with the rental property, is that people will rent to, related parties and whatnot, and then that will distort the level of the rental price, because if it was a market transaction, then you would have the rental price would be based on the market, right? If it's a related party transaction, that muddies up the water there, because once again, now you've got a transaction that may not be based on market price, and you can't really trust the rentability of the unit, given the fact that it's a personal or it's a related party transaction. So the rent you charge isn't a fair rental price if it is substantially less than the rents charged for other properties that are similar to your property in your area. So obviously, if the IRS was to test this out, they can clearly say, okay, well, it looks like the rent that you're charging here is way lower than, related properties. So it doesn't look like this is a fair market price of the rental property that's being charged in it. So ask yourself the following questions when comparing another property with yours. Is it used for the same purpose? So then you might think, well, what is a fair rental price? How can I come up with basically a fair rental price and make sure I'm charging a fair rental price so that I can have a property that I can then deduct possibly the expenses to? So is it similar to other property? Is it approximately the same in usage? And if it is, you're using this comparison to kind of determine what your rent should be and what should be the fair rental price. Obviously, you would do this if you were renting the property to a market person, someone you're not related to. If it's someone you are related to or something like that, that's when, of course, you got to make sure, you got to go through the due diligence and make sure that the rental price is fair, so that so that you can make sure that you're in compliance to be allowed to take any kind of expenses related to it. So it is approximately the same condition. Does it have similar furnishing? Is it in a similar location? So possibly the most important one here, the location. It's all about location with the real estate, right? They say it 3 times all the time. Location, location, location. Okay, example. Your beach cottage was available for rent from June 1st through August 31st, 92 days, except for the first week in August, 7 days, when you were unable to find a renter. So we had it available for the 92 days, but 7 days it didn't have a renter. You rented the cottage at a fair rental price during that time. So we used a fair rental price. We don't have that kind of problem with the rental price being under the market price. The person who rented the cottage for July allowed you to use it over the weekend, 2 days, without any reduction in or refund of rent. Your family also used the cottage during the last 2 weeks of May, 14 days. The cottage wasn't used at all before May 17th or after August 31st. When you figure the part of the cottage expenses to treat as rental expenses as follows. So under this scenario, you're going to say, all right, so how am I going to be breaking out the rental expenses under this scenario? So the cottage was used for rental a total of 85 days. So that's going to be the 97 days minus the 7 that it wasn't rented. In other words, they're pulling out the 7 days that wasn't actually rented out, even though it was available or on the market. The days it was available for rent but not rented, 7 days aren't days of the rental use. So we had to take those out. The July weekend, 2 days, you used it is rental use because you received a fair market price. So we had this kind of funny circumstance where we got to use it on the weekends, but we were still collecting rent on it for fair market price. So we didn't have to take out those 2 days when calculating our item here. So you used the cottage for personal use for 14 days, the last 2 weeks in May. So the total use of the cottage was 99 days. So notice we're not just taking the denominator at the 365 days. We're calculating the personal days used. So we used it for personal use for 14 days. So if we add that together, then we're getting the 99 days of use for the year. And it would be nice to have a lower denominator rather than just using 365 days. Or, if you were trying to increase the rental expenses that you can allocate, you would like to be able to say, hey, look, I had it on the market to be able to rent for the entire year. Even though it wasn't rented, it was still kind of rental property. And so I'd like to allocate the rest of the 365 days over the 99 to rental property usage. And the IRS is basically saying, well, no, you can't do that. It's only we recommend that you only use it when you actually had renters in it. And the IRS's position, you can imagine the IRS possibly trying to want to be able to say, hey, look, anytime that wasn't actually rented, we want to call that personal usage, and that would lower the amount of expenses that you would get to deduct. And you're saying, well, basically you don't have to do that either. What you need to do is figure out the actual usage when it was actually rented or you were actually kind of using it. And so that's going to be the 99 days, which is kind of a compromise between those two positions. So your rental expenses are 85 over 99, which is going to be 86% of the cottage expenses. So that's what you're going to basically be using to do your allocation then. Note, when determining whether you use the cottage as a home, the July weekend 2 days you used it is considered personal use even though you received a fair rental price for the weekend. So if you're trying to determine whether it's, used as a home or not, then that kind of exception of the 2 days isn't really an exception for that determination. So therefore, you had 16 days of personal use, 83 days of rental use for this purpose. Because you used the cottage for personal purposes, more than 14 days and more than 10% of the days of rental use, 8 days, you used it as a home. So that means if you have a net loss, you may not be able to deduct all the rental expenses related to the loss. So the dwelling unit, so that's going to be, if you want more information on that, remember you got to look at the dwelling unit used as a home.